It is a very confusing time right now to be following macroeconomics. We have some people saying we're about to enter a economic expansion. We have others saying we're about to enter a recession. Some people think Jerome Powell should be cutting rates. Others think he should be hiking. Right now, we are in the midst of a very complicated economic backdrop. But if you stick around and watch this video, I promise you by the end, you'll have a much better understanding of what's actually going on. But I want to introduce myself. I am Ryan Hartung. I am a member of the Macro Institute. I am on the research team here. We do institutional level macroeconomic research, as well as offer a professional designation for those looking to verse themselves in top-down investing. Okay, so right now, there is a big, unusual push and pull of economic forces in the US economy. There is major stimulus in the face of growing economic headwinds. And so I broke it down for you here in this table. There are a bunch of different opportunities. There are a bunch of different risks that we currently face. And this is why you can make an argument either way. So those saying we're about to enter an expansion, they have some things that they can show to prove that they're right. And on the flip side, those thinking we're about to enter a recession, they have some things on their side that they can say. So I'm going to break down all of those things for you. You can view the left side, the opportunities column here, as sort of good news, and the right side, risks, as bad news. And I also broke it down by time frame. Now, normally here, I would ask, do you want the good news or the bad news first? But unfortunately for you guys, you don't get a choice. We are starting with the good news, and we're going to start with the near-term good news. Fiscal policy is a net positive right now for the U.S. economy. Now, before I go any further, as Francois Trahan, our founder, always says, we do policies, not politics. Of course, within our field, we need to talk about politics-adjacent things. But what we're really focused on is how they impact the economy. And that'll be the only thing you hear me talking about in this video. So we just got the quote-unquote big, beautiful bill. And what that did, the biggest beneficiaries of the recent tax cuts were the people who make the most money. And what do the people that make the most money do? They carry retail spending. So as you can see here, almost 70% of consumer spending is made up of the top quintiles of earners. So what happens if you give those people more money? They are going to spend some of that money. And this creates a stimulative backdrop for the US economy. Now, and this also goes to show there's a reason why this is in the near term and why it's difficult for politicians to do austerity packages, because there is a bit of a sugar rush after big stimulative fiscal policy measures, right? Everyone has more money, everyone's feeling happy, and we're sort of pushing the debt conversation further down the road. However, in the near term, this is a positive. Then we move on to the intermediate term. Also good news, monetary policy appears to be working normally. So with all of the current talk about rate cuts, I think it's easy to forget that the Fed actually cut rates 100 basis points the end of 2024, and we are still working our way through the lead lag of that situation. So as you can see here, I show the US Fed fund rates with the money supply and its relationship. And as you can see, the relationship is very tight right now, and money supply has been growing at a 9-month lag right alongside that decrease in the federal funds rate. In this chart, you will see that the federal funds rate is inverted. So when it's moving higher, it's actually decreasing. And so we still have some stimulus built into the pipeline that we still have not worked through. And again, that would point to the column of maybe we're not done, some sort of expansion in the economy. And then finally, for the good news, we get longer term. AI is structurally supportive alongside obviously the building of the data centers of the US economy. So what we saw starting, it looks like in this chart, about 2022, huge increases in US private construction spending, specifically when it comes to manufacturing. Again, look at the history of this chart, this brought it up to unprecedented levels. And a lot of that is being credited to this AI boom, as well as a little bit of reshoring. I'm a little bit skeptical how much of that is due to tariffs, just because, it's a huge endeavor to bring manufacturing back to the US. And as we'll talk about soon, we don't necessarily have the labor force right now to accommodate that. However, when it comes to AI, we've definitely seen a huge boost in spending, and that is over the long term supportive of the US economy. Now, before we get into the bad news, I just want to say that this is just a small touch of the research that we do every single week. So if you're looking for our deeper dives into these topics, and specifically, one, our opinions and what we think is actually going on, as well as what that means for the investment environment, then I encourage you to reach out and discuss how you can become one of our clients. And then on the flip side, if you're a junior or mid-level professional that's looking to step up their investment game, we have a professional designation that focuses on these things called the macro specialist designation. And I would encourage you to take a look at what we have to offer, and feel free to reach out to me if you have any questions. Okay, now on to the bad news. So bad news, near term. If you looked at that table on the first page, you may have noticed that all of these were inflation related. And that is true. All of these are going to be different forms of inflationary pressures over different time periods. So in the near term, we are worried about tariff-fueled inflation, as we believe it could be a real problem for the economy as well as equities. Now, this chart, or this screenshot of a chart from Bloomberg, is a little out of date. It doesn't have it hasn't been adjusted for the new level of tariffs that we saw at the beginning of this month. However, even looking at this, I want you to take a look at the multicolored line near the end of the timeline on the chart. And if you look at the key, that sort of breaks down the tariffs into different categories between implemented, under investigation, and paused. And even back before the August round of tariffs, you can see that this was getting up close to potentially 30% if you add all of those things together when it came to an average tariff rate. Now, we estimate that I believe our most recent estimate is around 17-18%. However, you can see that quickly this number could get really, really high. If some of these paused or under investigation tariffs are either increased or started to be implemented. And why are we concerned? Well, you can see the little clip chart here on the right. We take an average of the regional PMI prices paid series, and advanced on headline CPI, you can see it leads it by about 3 months. And we've seen an increase in the prices paid level of those series. And generally what you see, again, 3-month lag, 3 months later, you will see an increase in CPI. And generally speaking, this is not the only reason, but a reason why Jerome Powell has hesitated to cut rates. He has specifically mentioned multiple times the uncertainty in the near term surrounding tariff-fueled inflation. So this is the bad news in the near term. Combine the tariff-fueled inflation with the uncertainty of tariff-fueled inflation, and it's not a good combination, and it's something that's pushing back towards the near-term stimulus that we talked about earlier. So then we get on to the intermediate term bad news, and that is that the immigration policy is an inflationary problem for U.S. labor markets. I'm going to run you through a scenario on the longer term bad news that might make this dynamic a little bit clear, because intermediate term and our long-term bad news are semi-related, but I'm just going to explain these charts. So on the left here, you see from the NFIB, few and no qualified job applicants. So when there's a job put out, if a company experiences few or no quality job applicants, this series ticks higher. And then on the right, you have the quits rate. And again, these two series working well together make sense. If there's not a huge supply of quality labor, then quality labor is in demand. And so then you see more and more people quitting their jobs to demand higher wages or just better working situations overall. And that's generally what you see here on the right. So when the labor supply is in power, when there's a mismatch between labor demand and labor supply, you generally see wages increase, and wage increases are a big part of the CPI situation. And so why are we worried? Well, immigration policy right now has removed, either directly removed via deportations or through disencouraging, I should say, immigration, some of the inflow of workers that we are used to are not coming. So we're in a situation where labor markets are really tight, which means upward pressure on wage inflation, and we don't necessarily have the supply incoming to alleviate that situation. And as I mentioned, this is related, the longer term. This is more of a structural dearth of workers, which again brings inflationary consequences. So if you've been watching our videos for a while, you've seen me use this chart before. It's one we use a lot. Right now, we are in a situation where there are more job openings than there are unemployed workers. That's happened before, as you can see here, in the early 1950s, as well as the mid to late 1960s. And if you're familiar with history, you'll know this was around the time of the Korean and Vietnam Wars. So right now, we are in a situation that we only have previously been in during war times. And that is, there are more job openings than unemployed workers. And I told you I'd run you through a situation. We're going to do two hypotheticals here. So the first is me and you are going after one job. There's only one job that exists that me and you want, and we're in a negotiation. And the employer says, you know what? I'm willing to hire you both. I'm just going to take whoever's going to do it for the least amount of money. And I say, I'll do it for $100,000. You say, you'll do it for $90,000. Then I say, I'll do it for $75,000. And the employer says, deal. All right, $75,000. So I came into that situation wanting $100,000, but because there was more workers for that one job, we negotiated ourselves down. So that puts deflationary pressure on wages, even though generally you don't see wage deflation. Just an example. And then the flip side, this is what we're currently experiencing. Let's say me and you are employers, and we're both going after one candidate. There's only one qualified candidate for this job that we're both trying to hire for. And the candidate comes to us and says, hey, I've been interviewing with you guys. I'm just going to work for whoever pays us the most. And so I say, all right, I'll pay you $100K. You say, all right, I'll pay you $125K. I say, all right, I'll pay you $150K. And that's where you get the upward pressure on wages as more and more employers are competing in a tight labor supply environment. So this is a long-term dynamic that, again, is related to the intermediate term. If we don't have an inflow of workers via immigration, our general demographics, baby boomers are aging. We're not having as many kids in this country as we used to. This could be a long-term dynamic that leads to wage inflation, which again is tied in with overall inflation. And that's what creates the economic dilemma. So are we about to enter a recovery? Are we about to enter a recession? It really depends what type of data you are looking at. Again, our research arm has a formal opinion on this that we talk about every single week. So if you want our formal opinion on the Macro Institute, you'll need to reach out and become a client. However, I can leave you with these questions to think about. So if you look at interest rates or the stimuli that is in the stimulus, that is built into the economy right now, that tells us that PMIs like the Empire Fed might be expanding in the near future. However, if you take a look at series like the prices paid on the right, that shows a completely different story where the Empire New Orders Index looks like it's set to decrease. So again, this is a very complicated economic backdrop. Sorry if I didn't answer your questions and lead you one way or the other. Again, you got to be a client for that. However, I do hope that via this video, you now have a better understanding of what's going on. and you can work to form your own opinion. That's where I'm going to leave you today. I really appreciate you watching this video. If you learned anything new, I would encourage you to subscribe to the channel. I will talk to everyone soon.